The British economy is in crisis.
The government has lost control of the British economy.
In recent times, under Britain's new Prime Minister and Chancellor, the figures released by the Office for National Statistics show that the UK economy has shrunk as the UK economy is forecast to be at risk of falling into recession.
The British pound has fallen to its lowest level ever against the US dollar.
The City of London woke up to a currency crisis,
shocking the markets and leading the Bank of England to intervene.
The Bank of England has said that it will buy as many long-dated government bonds as required.
The international monetary policy has slammed to the government plan, how bad it is and any worse to come to England. We will discuss what's happening in this video. It all began when the government of new UK Chancellor unveiled its plan for the biggest tax cuts in 50 years, the so-called mini-budget proposed tax cuts for the UK's highest earner and in the favour of the rich in Britain. Kwasi Kwarteng announces the 45% additional rate income tax ban for those earning more than £150,000 will be scrapped entirely. Besides, the Chancellor will bring forward a cut in the basis rate of income tax from 20% to 19% by April 2023. Kwasi Kwarteng says next year increase in corporation tax from 19% to 25% will be cancelled. It will remain at 19% and we will have the lowest rate of corporation tax in the group of 20. It means reversing the tax rise will put £19 billion a year back into the economy with the aim to reinvest, create jobs, raise wage, and pay dividends which support our pensions. People buying a property should benefit from the tax break since it will ease cost pressures on buyers in the short term. The first-time buyer threshold change means we could see more first-time buyers who can afford it making a jump to the bigger home as their first move, according to Tim Bannister, Whitemoor's housing expert. And the main tax changes predominantly apply in England, Wales, and Northern Ireland. According to Chancellor Kwasi Kwarteng, the aim was to lift the struggling UK economy and cut the risk of a near-term downturn. The mini-budget were absolutely essential in resetting the debate around growth and focusing us on delivering much better growth outcomes, he told the reporters when asked if it had been an economic disaster. Furthermore, the Prime Minister hopes that tax cuts, especially income tax cuts, will prevent people from facing high energy bills, curb inflation, and further economic growth. She also blamed the UK economic crisis brought about by Putin's wars in Ukraine, but nothing from her policy. It is indisputable that the rich are the biggest winner of Britain's tax-cutting gamble. The United Kingdom big tax-cutting gamble to boost the economic growth will benefit the rich far more than millions of people on lower incomes. Since the tax cuts dropped from 45% to 40%, it means that people whose income £20,000 a year will gain £157. Someone earning £200,000 a year will gain £5,220. Someone on £1 million a year will be more than £55,000. However, an effort to boost the UK economic growth is backfiring to an extraordinary degree. It blew a huge hole in the nation's finances and its credibility with investors. The International Monetary Fund warned that the tax cuts, the biggest in Britain since the early 1970s, would likely increase inflation, investments drop, and inequality. The yields on 10-year UK government bonds rose from 3.5% to 4.3% before falling back to about 4.05% on Friday after the Bank of England's intervention. For those who don't know, yields are effectively the cost of borrowing to an issuer, in this case is the UK government, Rising bond yields suggest a lack of willingness among investors to owe the debt, as buyers demand a lower price to buy them. But at the same time, in contrast to oversoaring government bonds, London stock fell sharply in the bond market with no hesitation, especially pension funds. The mini-budget also injects more cash into the economy, leading to the UK's consumer price index to rise 10.1% in the 12 months to July 2022, marking the highest increase in the cost of living in the UK since February 1982. But the worst thing coming to Britain is the pound crash. The pound fell to a record low of 1.03 against the US dollar on Monday after quoting double down on his £45 billion packet of taskers by pledging to go further. So, the British pound is falling against the dollar, but what does that mean exactly? As the value of sterling falls, it becomes more expensive to import essential goods, typically bad for US dollars like food and fuel, and for those who are able to go overseas, holidays are also more expensive because the pound's worth less against the dollar. That could fan decades-high inflation that's stoking a cost of living crisis for millions of households. Then there's the rapid rise in borrowing costs for the government, businesses, and households. To cope with the UK financial meltdown, the Bank of England were forced to intervene. But what is exactly the policy of the Bank of England? The Bank of England were forced to intervene in the long-dated bond market after a steep sell-off of UK government bonds, known as wills, threatened the country's financial stability.
Central bank looking to put down a revolt in the financial markets there.
They did a dramatic intervention today to try to calm the markets following the turmoil after last week's mini-budget.
They worked through the night and came up with an unprecedented.
But why did the Bank of England intervene in the bond market? Through purchasing bonds, the Bank of England is looking forward to reversing what it sees as their function in the bond market, because if not, there could be a material risk to the UK financial stability. In more detail, the central bank seeks to address the problem that threatens pension funds. Significant pension funds, including Legal and General plus Phoenix Group, saw their share prices lie on the London stock market. Prior to the Bank of England intervention, certain pension funds had used derivatives to protect themselves from low bond yields. However, as bond interest rates rose sharply, which known as the international monetary policy from the Bank of England to curb the inflation resulting from the mini-budget, it leads to the higher cost of borrowing money, and derivatives contracts require the pension funds to pledge more collateral. After using up existing cash reserves, the funds sold off bonds to meet their obligations. This put more bonds into circulation, drove down prices even more, which in turn resulted in more calls for collateral, and again, which led more bonds being sold off. On calls a doom. This is similar to what happened following the 1922 Wall Street crash, the Black Monday stock market collapse in 1987, and in the wake of the 2008 global financial crisis. The Bank of England were pushed into a comprehensive financial crisis, with the announcement on September 28 that it was ready to launch $65 billion to temporarily buy back government bonds. For a short time, interest rates on government debt fell on Wednesdays after the bank intervened, with a 30-year bond rate moving from above 5% to below 4%. The current bond buying program runs until 40 October and may be enough to calm the water until then.
However, this policy from the BOE was just temporary to relieve the currency market, since it may cause inflation. The government needs to revise the hard-cutting plans to put an end to the UK financial crisis.